In 2023, a delivery driver in Chicago got into a small car accident on his way home after a 12-hour shift. Nothing life-threatening, no major injuries, but within weeks, his entire financial life started collapsing. First came the hospital bill, then the insurance calls, then the confusing paperwork, then the shocking part. Even though he had insurance, he discovered his deductible was so high he still owed thousands of dollars himself. Suddenly, his savings disappeared, credit card debt increased, collection notices started arriving. And while he was struggling to survive financially, he noticed something strange. His friend, a corporate executive with premium insurance, received completely different treatment after a similar accident months earlier. Faster claim approvals, better hospital options, private support lines, less waiting, less stress. That is when he realized something most Americans slowly discover the hard way. Insurance companies do not treat everyone equally. They treat people differently depending on risk, income level, location, and financial value. And honestly, once you notice it, you cannot unsee it anymore. In America, insurance is supposed to represent protection, safety, stability, peace of mind. But financially, insurance companies are still businesses first. Their goal is not simply helping people. Their goal is managing risk profitably. That means every customer becomes data: income data, health data, credit data, neighborhood data, driving history, spending behavior, age, lifestyle. Everything gets analyzed. And the higher your financial value to the company, the differently you are often treated. This becomes painfully obvious across every part of American life: health insurance, car insurance, home insurance, even life insurance. Wealthier Americans usually receive faster service, better options, lower long-term rates, and more flexibility because financially they represent lower risk and higher profitability. Meanwhile, lower-income Americans often face stricter terms, higher deductibles, more denied claims, and less protection, despite needing help the most. And psychologically, that creates enormous frustration because people assume insurance means equal security. But in reality, modern insurance systems often reflect class differences inside American society itself. Think about health insurance alone. A corporate employee with premium employer coverage might have access to better hospitals, specialists, shorter waiting periods, and lower out-of-pocket costs. Meanwhile, a lower-income worker may delay medical treatment entirely because even insured care feels financially terrifying. Millions of Americans today avoid going to hospitals not because they are irresponsible, but because they are afraid of the financial aftermath. That fear changes human behavior deeply. People ignore symptoms, delay treatments, avoid ambulances, skip prescriptions. Financial anxiety becomes part of healthcare itself, and insurance companies understand this psychology extremely well. The same thing happens with car insurance. Drivers in lower-income zip codes often pay significantly higher premiums, even with similar driving records, because insurance systems analyze statistical risk geographically. In many cases, poor Americans pay more for less coverage, while wealthier Americans receive better protection at lower relative cost. That sounds unfair, because honestly, it often feels unfair. But insurance companies operate through probability models, not emotion. Everything becomes numbers, risk categories, profit margins, statistical behavior. The emotional reality of people's lives often comes second. And that disconnect is exactly why so many Americans feel financially abandoned during emergencies, despite paying insurance for years. If you're new here, subscribe to Andrew Finance, because this channel is about the real psychology behind money, survival, and modern American society. And honestly, insurance may be one of the clearest examples of how money quietly changes the way systems treat people in America today.
One of the most uncomfortable truths about insurance in America is that your income level quietly affects how much stress you experience during emergencies. Two people can suffer the exact same accident, illness, or disaster and walk away with completely different financial outcomes simply because one person has better coverage, stronger savings, or higher economic status. And psychologically, that creates a version of America where protection itself feels unequal. Imagine two families dealing with the same house fire. One family lives in an upper-middle-class neighborhood with strong homeowners insurance, emergency savings, and access to attorneys if needed. The other family lives paycheck to paycheck with minimal coverage because cheaper insurance was all they could afford. The fire itself may be identical, but financially, the aftermath becomes completely different worlds. One family temporarily relocates to a hotel covered by insurance while repairs begin quickly. The other spends weeks arguing over claim approvals, coverage limits, missing documentation, and unexpected expenses. That difference changes how people emotionally experience disasters. Wealth often buys speed, convenience, and recovery power. Lower income usually means more paperwork, more delays, and more financial pain during already stressful moments. This is why many Americans quietly feel insurance works best for people who already have money. And honestly, that belief did not appear randomly. Across the country, lower-income families often choose insurance plans based entirely on monthly affordability instead of long-term protection. High deductibles become normal, limited coverage becomes normal, huge out-of-pocket risks become normal. People accept dangerous financial exposure because surviving month to month matters more than preparing for emergencies years away. Insurance companies understand this behavior deeply. They know financially stressed customers are more likely to prioritize lower monthly payments, even if the long-term protection is weak. And when emergencies finally happen, many families discover too late how little coverage they truly had. That moment creates enormous anger because people feel betrayed by a system they believed was protecting them. But from the company perspective, the terms were technically always there inside the policy. This is where finance psychology becomes important. Most Americans do not actually read insurance policies carefully. The language feels complicated intentionally. Pages of legal wording, exclusions, conditions, limitations, and technical definitions overwhelm ordinary people. So emotionally, many customers operate on assumptions instead of understanding. They believe having insurance automatically means safety. But financially, coverage quality matters far more than simply having a policy. Wealthier Americans often understand this because they have financial advisors, attorneys, accountants, or experience navigating complex systems. Meanwhile, many middle and lower-income Americans must figure everything out alone during moments of crisis, and that imbalance creates huge differences in outcomes. Another thing people rarely notice is how insurance companies often view customers through predictive behavior models. Credit scores, claim history, payment consistency, and even location patterns influence how customers are categorized. In some states, poor credit alone can increase insurance costs dramatically, even if driving history remains clean. That means financial hardship itself can make protection more expensive, creating a cycle many Americans struggle to escape. The poorer someone becomes, the more financially vulnerable they often become to future emergencies too. And emotionally, that pressure can feel suffocating. If this video is helping you understand how money quietly shapes everyday life in America, subscribe to Andrew Finance because most financial systems affect people psychologically long before people fully notice the economic consequences. And honestly, insurance may be one of the clearest examples of that reality in modern society today.
At the highest income levels, insurance functions very differently. Wealthy Americans do not just buy protection, they buy access, speed, influence, and reduced inconvenience. That is the part most ordinary people never fully see because financially elite systems usually operate quietly in the background. A millionaire dealing with a medical issue often experiences an entirely different version of healthcare than a working-class American. Faster appointments, better specialists, concierge medical services, private hospital rooms, dedicated claim representatives. Even the emotional experience feels different because financial fear is reduced, and psychologically, that matters more than people realize. Stress changes how humans recover from crises. Financial fear magnifies every emergency emotionally. Meanwhile, wealth creates breathing room.
This difference becomes visible after natural disasters, too. After hurricanes, floods, or wildfires in America, wealthier homeowners often recover faster because they have stronger coverage, legal support, savings, and flexibility. Lower-income families may spend months or years financially rebuilding while fighting insurance disputes simultaneously. Some never fully recover at all. That creates a painful reality in modern America. Insurance does not only protect wealth. In many ways, it also helps preserve class stability itself. People with financial resources usually recover faster from setbacks, while financially vulnerable people often fall deeper into instability after emergencies. And honestly, that cycle explains why one accident, illness, or disaster can permanently alter someone's financial future. Another uncomfortable truth is that insurance companies often become more cooperative when large amounts of money or influential clients are involved. Wealthy customers may receive personalized service because retaining high-value clients is profitable. Meanwhile, average customers are often processed through massive automated systems designed around efficiency and cost control. That can make ordinary Americans feel invisible during stressful situations. Endless hold times, repeated paperwork, delayed responses, confusing claim investigations. Many people eventually give up fighting simply because emotional exhaustion becomes overwhelming. Insurance companies understand this psychology too. The longer disputes continue, the more financially desperate customers sometimes become, and desperation changes negotiation power completely. This is why financially educated Americans often focus heavily on understanding policies before emergencies happen, because once disaster strikes, emotions take over and clear decision-making becomes harder. The smartest financial move is usually preparing while life feels stable, not reacting after chaos begins. But sadly, many Americans cannot afford ideal preparation. Rising rent, debt, inflation, healthcare costs, and stagnant wages already stretch millions of families to the limit. Insurance becomes another monthly survival expense instead of genuine security. And when people are financially exhausted, long-term planning becomes psychologically difficult. Survival thinking always prioritizes the present moment first. That is human nature. So how do insurance companies treat people at every income level? In many ways, they treat people based on financial risk, profitability, and recovery potential. The wealthy often experience insurance as convenience. The middle class experiences insurance as protection mixed with constant financial anxiety. Lower-income Americans often experience insurance as incomplete security filled with loopholes, fear, and uncertainty. That sounds harsh, but for millions of families, it feels painfully real. And understanding that reality matters because financial systems shape human lives far beyond money itself. They shape stress levels, recovery speed, mental health, and long-term stability. If you enjoyed this video, subscribe to Andrew Finance for more realistic conversations about money, class, psychology, and modern American life. Like the video, share it with someone trying to understand how financial systems really operate. And remember this, in America, the more financial stability you already have, the easier it often becomes to protect yourself from future financial disasters.
If this video opened your eyes, make sure you subscribe, because what you learn today can save your future tomorrow.